IAS 12 says the objective is to prescribe the accounting treatment for income taxes. So remember, we talk about multiple number of and different forms of taxation. Here IAS 12 has been specifically focusing only on one kind of taxes. What is it? Income taxes. We talk about current taxes and deferred taxes, and still that is only in relation to income taxes, and no other taxes are spoken about in this particular discussions of IAS 12. Remember please, that's very important, it's only income taxes. So what does it say? The objective, the principal issue in accounting for income taxes is how to account for the current and future tax consequences. Now remember, you learn taxation as a separate module. Here, not that do we talk about the tax computations, no. You get the tax consultants to complete your tax computations, let them do that job, and what are we here for? It's only just that we need to discuss how the calculated income taxes are accounted. You might think that the accounting part is very simple and straightforward. No. Especially when it comes to deferred tax calculations, a lot of complications can be there, and a lot of understanding has to be there. Some thinking has to go into that. You can't just do it just for the sake of doing. So remember, the objective is to prescribe the accounting treatment for income taxes, and nowhere do we learn how to do tax calculations, and that is not the purpose, and that is not the objective of IAS 12. Then the future recovery of the carrying amount of assets that are recognized in entity statements of financial positions. We know taxes are always paid on self-assessment basis. You do your own assessment. I mean, if you are not so familiar and conversant about tax law, you will get your tax consultants to complete your tax computations. And that is what you think is correct, and that is what you pay to the department, you pay to the tax authorities. Actual tax liability has to be based on the assessment of the tax authority. We pay what we think is correct, but ultimately the final tax obligations, final tax liability has to be the liability assessed by the government tax authority. Sometimes whatever you paid may be an underpayment, so you need to pay the balance and finish it off. Or whatever you have already paid may be an overpayment. You have paid more than what you are obliged to pay. Then there is an overpayment, and the overpayment can be recovered. So that's what it says, the future recovery of the carrying amount of assets that are recognized in an entity statement of financial position. Transaction and other events of the current period that are recognized in an enterprise's financial statements. Transactions and other events of the current period that are recognized in an enterprise's financial statements. So let me explain these objectives. Also, let me explain why deferred tax calculations in particular are considered to be so important in financial report. And you do not know what deferred taxes are for the moment. You would have heard about current taxes, I'm not pretty sure, though, but you wouldn't have heard about deferred taxes. I must tell you what deferred taxes and current taxes are. Just for the moment, remember, current taxes are any taxes calculated on your taxable profit. So basically, we know in any country all over the world, you need to normally do two profit calculations. What are these two profit calculations? You need to first complete your accounting profit calculations. But that is not what the taxes are paid on. Everywhere in the world, you need to perform another profit calculations. That is what the taxes are calculated on. So for accounting purpose, you need to prepare profit and loss where the accounting profit will be shown, And for tax purpose, you need to do another profit calculations in order to determine your tax obligations. Accounting profit has to be always based on financial reporting standard IFRSs. You recognize your revenue based on IFRS 15. You recognize your leases based on IFRS 16. You recognize your financial instruments based on IFRS 9. You recognize your investment properties based on IAS 40. So accounting profit has been calculated based on IFRSs, but taxable profit, which can be completely different from accounting profit, is calculated based on the tax law in that particular jurisdiction. So however much you calculate your accounting profit, remember that's not what the taxes are paid on. So apart from you having this accounting profit, you need to perform another calculations which you call taxable profit calculations. So that's what the taxes will be paid on. So in our discussions, we talk about two kinds of taxes. One is accounting profit. We talk about two kinds of profits. One has to be accounting profit. The other one has to be the taxable profit. So what is the accounting profit? The accounting profit is the profit calculated based on IFRSs, and that has to be the profit in the profit and loss statement before paying taxes. And taxable profit has to be another profit calculations done elsewhere. It has got nothing to do with the accounting profit calculations, and that is exclusively based on the tax law in that particular jurisdictions. So throughout our discussions of IAS 12, we will keep talking about accounting profit. Also, we will keep talking about taxable profit. Now, before we proceed further, I want you all to understand how important this concept is. What is the concept? Deferred tax concept. So let me take a simple illustrative example to explain how important it is, and then we can embark on the balanced technical part of IAS 12.